tariffs and trade wars are starting to dominate the headlines, and that's leading to a little bit of volatility in the market. So in this brief SCM insight, I thought we'd take a look at the data behind what's happening. Now, understanding trade is obviously not something that most of us have focused much on, and we hear a lot of rhetoric out there. But the first thing I want to take a look at is the current account balance. Now, one thing you'll notice about this briefly, the current account balance is just the balance of payments, money going into a country versus money coming into our country. So if it's negative, we have more cash flow essentially going out to other countries. And the first thing you'll notice here is the line there for Japan was the one dominating our current account balance and our deficit that the U.S. saw. That's that big negative number down there, and you saw a strong correlation with Japan early on as we started to work on global trade way back, in the Nixon and Reagan years, and it definitely continued hurting us. Well, we've seen something interesting is Germany actually has the biggest current account surplus with the United States. Still, Japan is in there, and then you see China there near the bottom with that orange line. So it's interesting that we've paid so much attention to China when the actual money going back and forth is not that big of a deal when you look at other countries. However, if you look at just the goods traded back and forth, the net of what we export to China versus what we import, you'll see that's 47% of our trade deficit when you're looking at just goods. Now, the question is, how in the world can they have such a small current account balance? And it's something we don't have time to get into today, but we saw it most recently in the Virginia area with a Chinese firm buying Genworth. And the reason we have such a neutral, if you will, current account deficit with China is because we see the Chinese making a lot of investments in the United States. Now, that might scare some people. I'm going to remain neutral on that until we see what happens. But you'll notice we had some of the similar things happening with Japan. Now, the other thing that I want to focus on today is how much does trade really impact the actual economic output? So if we look at GDP and some of the components, you'll see, first of all, regardless of what time period we're looking at in this chart, the consumer is still the number one driver. We have seen a recent pickup in investment, which I think is a good thing, especially because it's US-led investment, not necessarily Chinese investment. That wouldn't show up in our GDP as much right there. But what I want to focus on is the net difference on trade. Now, if you look at just the last 12 months, we see that all the goods that we've imported actually subtracts from our GDP because that's money that we're spending and then we're sending out to another country. And it wasn't enough to offset the contribution of our exports. So when people are fearful that, oh, the Chinese are going to stop buying our stuff, really that's not necessarily a bad thing because everything that we buy from China is hurting our economy. So if we all of a sudden have tariffs and we start buying more things from other countries, it may actually be a net positive. So the data right now says, it's not that big of a deal. There's other countries involved. And really, we're just seeing something from the Trump administration that we honestly don't know until years down the road if it's going to have a positive impact. But overall, I think it will. I've talked for at least 10 years now about the need for us to control our deficits, and this one is talking about trade. Another video we'll do on the debt sometime down the road, but we need to get our deficits in order so that we can grow our economy over the long term. So the short-term focus on trade and what it might do to the economy, yes, it might hurt the economy a little bit, but it may help as well. We just don't know. And so when you start to see the market jumping around like that, the best thing to do is take a step back and look at the data. That's what we've always done at SCM. That's what we're doing right now. We are a modestly bullish position right now in almost all of our programs, but that can change as the data tells us to. So we ignore all this noise, and I hope you're able to too.